Today we're going to talk about a very unique tax refund, and that's the tax refund that happens when somebody makes money in a Ponzi scheme, and years later, when the Ponzi scheme explodes, a trustee in bankruptcy is appointed, and the trustee starts suing people who made money. And the trustee is often very successful in collecting money back. It's my understanding that almost everyone in the Madoff situation was able to get a great deal of their money back because the trustee did such a good job in getting what we call the clawback, meaning you've made profits and even at times you put principal into a Ponzi scheme. You withdrew the principal, you withdrew the profits, and you were not allowed to do that because there really was no money in the Ponzi scheme. It was all false profits, and the principal that you got back was non-existent. It was not your principal. It was money coming in from the investors after you. So that's the clawback. You can have a clawback of profits that you made, and you can have a clawback of principal. Many years ago, after the Madoff Ponzi scheme had been somewhat resolved, the Government Accounting Office came to several tax lawyers and asked us about the clawback and how we thought the clawback should be handled. And at that time, the Internal Revenue Service was really struggling with how do they treat payments repaid to a trustee, then distributed to the people who the trustee was able to help and get money back for them. The Government Accounting Office went to see the Internal Revenue Service about this very issue. And based on the information that several of us tax lawyers had given the General Accounting Office, the General Accounting Office was able to convince the Internal Revenue Service of exactly how they should handle these matters. And you'll see there a letter of thank you to me and others who were instrumental in helping the Internal Revenue Service to come to the right conclusions on how to handle clawbacks. A clawback is when a trustee recovers money from an investor who profited from the Ponzi scheme. There is a choice when you have a clawback. You can either deduct the amount of money that you have paid as a clawback of profits in the year you paid it, and then use that deduction to accomplish tax refunds. Or there is a very unique code section that we're going to focus on. That's a code section that allows you, in certain circumstances, to actually go back when there is a closed year from the statute of limitations. When you have made profits in that closed year, you cannot go back and get a deduction in that closed year. However, this special code section does allow you to actually go back to the closed year, reopen the statute of limitations, so long as you've met the requirements, and to actually get a tax refund from profits that you made in a closed year that you would not otherwise have been able to do. The clawback can come many years after the Ponzi scheme has run its course, and there is the right to either take a deduction in the year that you pay the clawback, or the right to go back, we call it the mitigation section, to mitigate your losses by going back to the year in which you made your profits. And if those years, your profits are going to bring you more of a tax refund than just taking a deduction, you're allowed to go back and actually get the larger tax refund. Now, we have to keep in mind that starting with the new Trump tax bill, whereas in the past, if you took a deduction, you could go back several years if the statute of limitation was open and file amended returns in those years to claim deductions if you had a loss. That's not the law anymore. So from this point on, under the new Trump tax bill, all you can do is carry your losses forward. And that can often mean that you're not taking the most advantage of your losses because now you're in a different tax bracket. You're not working as hard, your income has gone down, and therefore using the deductions going forward are not going to bring you the same kind of refunds as you would get if you're able to go back and take the deductions or to eliminate the income in the years you made the profits. That's typically eliminating the income from the highest tax brackets and leads to a much larger return of funds. There is a difference between a clawback of profits. Clawback of profits is where you can go back, use this mitigation section, and reopen the statute and take your tax refund based upon deductions in the years that you earn that money. There's also a clawback very often, not just of profits that one makes, but actually of principal. The trustees can go back, and if a person who has made money and taken out profits and their principal has done it within a certain time frame, the trustees can actually force the principal to be returned also and distribute among those people who lost money. Now, we'll see there's a distinctly different tax treatment between profits, which we can go back and mitigate and reopen the statute, and principal, where you have to take the deduction in the year you've made your payment of principal that you've invested in the Ponzi scheme, the year you've paid back to the trustee that principal that you were able to withdraw in the very last minutes. And there you can only take a deduction for the principal, whereas profits you can go back, reopen the statute, and claim refunds based upon the amount of taxes you paid in prior years. So we're going to study the clawback. The tax section is called the mitigation section. We're going to look at Ponzi schemes just for a minute to look at the Ponzi scheme loss and see how that compares with the clawback. Then we'll look at the taxation of the clawback of profits and the right to mitigation, and the taxation of the clawback of principal, which is only the right to a deduction in the year paid. And we're also going to look at a very interesting part of the mitigation section where not only can you go back and get refunds based upon taking your profits from the years in which you made these profits in the high tax bracket, but also being able to use those profits in a way where you can go back to years even prior to the year that you're getting your profits back and still have extra losses after that that you have not used. You can actually carry that back as if you were in a current year that would allow you carrybacks and benefit from both the refunds you get in the year you had the high taxes and refunds that you will get in the years prior to that where you can use the carryback of excess losses for additional repayments of profits. We call this the mitigation section. It falls under Internal Revenue Code section 1341. It permits one type of the clawback payment to be taken as an ordinary income deduction in the year in which the clawback income was originally taxed, even if the year is closed by the statute of limitations. The other type of payment, which is the repayment of principal that you had invested in your Ponzi scheme, that's only deductible in the year of payment, and then based on the Trump tax bill, only able to be carried forward. Important to understand that the clawback falls under the Internal Revenue Code section that deals with financial losses. The importance of this is because the Trump new tax bill left the ability to take deductions and to use the mitigation section in Ponzi schemes, because Ponzi schemes were transactions entered into for profits. The Trump tax bill went a long way to eliminate the deductions from thefts that were not thefts that were a result of you trying to make money in an investment scheme or in a business. As we said, there's no loss carrybacks or deductions from Ponzi schemes or a deduction from a clawback under the new Trump tax bill. However, if you claim the mitigation section, that's when you can go back and use your carrybacks and carry forwards. This unique section in the Internal Revenue Code, it's a little bit complicated, and that's because they did not want people who were really not entitled to go back and reopen the statute of limitations. They just didn't want everybody to be able to go back and reopen statutes and claim deductions. And they've limited it to a certain category of losses. And one has to understand this code section and to appreciate how valuable it is. This is designed to allow someone who pays funds back in a clawback to be able to go back to the year in which the clawback income was earned for tax purposes, exclude the income to calculate which tax result would be more valuable, to either claim the clawback as a deduction in the year in which it was incurred, or to claim the clawback as a deduction in the year in which it was paid, and be able to carry that forward. I have a chart here that is going to show you the drastic difference that the mitigation section can make. In this chart, what you'll see in the year 2012, we're saying that the investor made $200,000 in a Ponzi scheme. And the investor had other income from business or what have you of $200,000. So in the year 2012, the investor had taxable income of $400,000. We're assuming there was an average tax rate of 30%, and the total taxes paid were $120,000. Now we're going to go fast forward, and we're going to look at the year 2018. And now in the year 2018, the investor is forced to repay the $200,000 back to the trustee that the investor made in 2012. Now in 2018, the investor has not made as much money, and the investor is at a much lower tax bracket. So one can see that if in the year 2018 you claimed a deduction and you were only making $50,000 in that year, you would use up your $50,000 deduction. You'd use it up in a much lower tax bracket, let's say 15%, and in the year 2018, the only amount of refunds you would get would be $7,500, 15% of the $50,000 that you were able to wipe out with the deduction. Now, you are going to be able to carry the rest of your losses forward. However, in each one of those years, assuming you made only $50,000 a year in 2019 and 20 and 21, all you're going to get back is $7,500 each year for a 4-year period. You're going to have to wait for your money over that 4-year period and only collect $30,000 tax refund. If you're allowed to go back to the year 2012, when you made $200,000 and you made it in the 30% tax bracket, you can immediately use the mitigation section, and you're going to get a tax refund of $60,000 instead of $30,000 payable over 4 years going forward. So you can see from that example that maybe is a bit overdone how incredibly valuable this mitigation section can be. The mitigation section began as a result of what we call the claim of right doctrine. There's always been a doctrine that once a taxpayer receives income in a particular year, the taxpayer cannot go back and reopen the statute of limitations in that year if the really was not entitled to that income. This is basically a very inequitable situation, and that's where the mitigation section started. It just started with an unfair doctrine that would not allow you to get right under the tax laws. The mitigation section has 4 different requirements that must be met. Like I say, they do not want everyone to be able to take advantage of this section. You have to fit into certain categories to be able to take advantage of it. You should not be able to just voluntarily say, I want to go back and reopen the statutes. So the 4 elements that are required are the following. 1, you need to have an item of income, some type of taxable income, included in your prior taxable year. Second, it's important that in that year, it appeared that you had the right to that income. So, for example, the Ponzi scheme people who made profits, they did not know that these were not real profits. They did not know that they were being paid money back that was called profits when there were no profits. These were deposits being made by other people who were being scammed in the Ponzi scheme. It appeared to these taxpayers that they did have an unrestricted right to the income. The third requirement is that now that you come to a year when you have paid the trustee back money as a result of a clawback, you need to be able to claim a deduction in that year. The fourth requirement is that after the close of the taxable year that Ponzi scheme clawback was made, after the close of that year, that it's shown that the taxpayer never really had the right to put those profits in income. In other words, in the case of a Ponzi scheme, profits reported by a taxpayer in prior years were not profits. They were nothing more than funds put in by other Ponzi scheme victims and then paid out to the person as false profits. So you need to have an item of income. It must have appeared that in the year you put it in income, you did have a right to it. You must have, in the year that you pay it back, the right to consider it as a deduction. And you have to show that at the time you did repay that money, that you really didn't have the unrestricted right to that income. There's a fifth requirement here, which is an anachronism, and that is they did not want de minimis cases to arise for mitigation purposes, and the amount of the deduction that you're claiming has to be more than $3,000. Let's look at the different items that are required. First, there must be an item of gross income made in the year that you're trying to reopen. Item of gross income is a very, very broad definition. It's found in Code Section 61 of the Internal Revenue Code. It runs the gamut. Compensation for services, business income, sales of property, interest, rents, royalties, dividends, annuities, alimony, income from life insurance, distributive share or partnership income, income in respect of a decedent, income from an interest in a trust or estate, and even this is not all inclusive. If you have an item of income taxable as income in the prior year, you have met the item of income standard. We need to make a distinction here because when you are using the inventory system, there's not an item of income there because inventory has its own unique tax principles that determine profit, and it just doesn't fit as an item of income for mitigation purposes. The second requirement is that when you took that income into income in the prior year, you had the apparent right to the income. The Ponzi scheme people who profit certainly had the apparent right to the income. Profits were being reported by the culprit. These were false profits, but it was certainly apparently income, and these were profits that the taxpayer reported for tax purposes. This section doesn't apply if it appeared that the taxpayer had an unrestricted right to that income and there wasn't some kind of claim that could prove that you really did not have the right to the income. One court has stated that merely by a taxpayer reporting an item as taxable income in a tax return is a prima facie case that the taxpayer believed that this was an income item. The court stated that since the taxpayer took into income the item, it is clear that the taxpayer believed it had the right to that income. So the apparent right to income standard is pretty cut and dry. As I said, they did not want people to just be able to take advantage of the mitigation section unless they were really entitled to it and had it for the wrong reasons. So there's something called the claim of wrong exception to the mitigation code section. And that means if the taxpayer was a thief and the taxpayer really never had the right at all to that income, when that type of taxpayer repays profits in a clawback and there was no apparent right to those at all because it was just thievery, the taxpayer is not going to be able to take advantage of the mitigation section under those circumstances because it's not there for the benefit of wrongdoers. The IRS position is that a taxpayer cannot have any right to income and therefore claim mitigation for the repayment of that income if the original income was wrongly obtained. This claim of wrong exception really cannot apply to somebody who's a typical Ponzi scheme victim. You've got a taxpayer who loaned or invested money with a presumably trustworthy member of the community who turned out to be a fraud, and the clawback payer is a victim. The clawback payer is now repaying profits that were never his, and these might be profits that are long since spent. It is important, though, and I can't stress this enough, that when you have a clawback of a Ponzi scheme, profits or principal, it is very important to have a very well done settlement agreement that includes statements about the clawback victim's innocence and non-involvement in the Ponzi scheme. And you want to have, in addition to a settlement agreement, you want to make sure that the trustee writes you a very detailed letter explaining whether this was a clawback of profits, whether it was a clawback of principal, what years were involved here, and that's going to make it much easier to make use of the mitigation section when you've got that trustee letter. We're going to look at the third requirement that needs to be met if we're going to have a legitimate use of the mitigation section. The third requirement was that in the actual year of payment, the taxpayer pays the clawback. That payment must have a permitted deduction in that year. In the Ponzi scheme, I don't think it can be denied that when you are being forced by a trustee to pay back money that you legitimately thought was profits to you, that you should be entitled to a deduction there. The mitigation section in the Internal Revenue Code is not a section that permits you to take a deduction. It's a section that permits you to go back and reopen the code, but it's not a section that grants you the right to the deduction. The clawback losses are separated between a repayment of profits, and that's where profits are subject to the mitigation section. When you've repaid profits that you made, that's when you're in a position to say, I paid taxes on this in prior years. There were really no profits. I'm entitled to go back, go to the higher tax brackets where I have paid those profits, and have my refunds based on those higher tax brackets, not as a deduction. There's a big difference between profits and when the trustee is demanding a clawback of principal that has also been repaid to an investor. And this is not typical to have the trustee able to take back principal, but it can happen, and it does happen, when the person who has taken back that principal has taken it back very close to when the Ponzi scheme has exploded, and it's somewhat obvious that they knew that it was time to get out beforehand. We're going to take a look at this item of gross income standard because it's important to see that there's a close relationship between the funds that were reported as taxable income and the funds that are now being repaid. You have to be able to prove that these two things are events that really evolve from the same circumstances. And in the Ponzi scheme investment, that's pretty easy to prove. Had it not been for the Ponzi scheme investment, there would have not been tax on or reporting the payment of income that is now being returned in a clawback. The Ponzi scheme investment and the clawback are directly related to each other, and we have met the standard of being a result of the same circumstances. The clawback repayment certainly seems to be a direct result of the same circumstances and the same Ponzi scheme that caused the clawback victim to report income in the first place. The fourth requirement is the requirement that the repayment of the Ponzi scheme profits was made because in the past it never should have been included as funds in income. If the taxpayer included that money and he or she really had a right to it, and the taxpayer just simply repays profits, you're not going to be able to get the deduction. The deduction, or the mitigation section rather, is not intended to be used in a voluntary manner. The hallmark here is a case that says that you have established your right to the mitigation section if there is a good faith, non-collusive settlement agreement entered into to terminate litigation. This establishes that there was a liability to return the income, and it establishes that the taxpayer never had the unrestricted right to income for purposes of this mitigation section. The trustee collecting money from someone who made money, they have profits, they were not real profits, there was a trustee, there was a claim, and the trustee was able to claim money back, and a payment was made of profits. This establishes that liability was there, and there was never a true unrestricted right to the income. Here's two examples of this. We'll look at one case where a taxpayer made money from the sale of stock options, and later the Securities and Exchange Commission brought a proceeding against the taxpayer based on insider trading. The taxpayer did not just quit and walk away. The taxpayer settled the case, did not admit liability, and claimed that this was a settlement, and put to the test that this was not a voluntary repayment of funds. In this case, the settlement that was made at arm's length met the establishment requirement. In the next case, which sounds similar but is very different, a taxpayer bought and sold corporate stock in 1 year. An investigator found that the profit from the stock should have gone to the corporation, not the taxpayer. The taxpayer paid the money right away, did not want to get into a fight, wanted to avoid controversy so that the taxpayer did not suffer harm to his professional career. In that court, the court said that though a judicial determination is not required, it is necessary that the taxpayer needs to demonstrate at least the probable validity to the taxpayer's claim to the funds that were repaid. Without putting up a fight there, you get into the question of, well, if this was voluntarily given, we're not going to let a voluntary payment take advantage of the mitigation section. We'd have way too many of those going back simply to reopen statute when that shouldn't be the case. Let's summarize what we now know about the clawback of profits. The Ponzi scheme clawback of profits passes all the tests of the mitigation section. The perpetrators promised extraordinary returns in almost every one of the many types of listed income items. You will find every type of item that I listed as an item of income. There's been a Ponzi scheme that made either false rental profits, false interest, false capital gains. There'll be a Ponzi scheme to fit every one of those. The taxpayer believes at the time that the taxpayer should have taken that item into income and paid the tax on the income. Then the taxpayer finds out that the taxpayer needs to repay those funds, and that the taxpayer is entitled to a deduction in the year of repayment. And the successful trustee in the clawback will have established, by virtue of the collecting the clawback, that the taxpayer never had the right to that income. So there was no voluntary repayments. What we just covered on how to deal with the clawback of profits, how to take advantage of the mitigation section, and the standards that must be lived up to. There is an IRS publication that will be very helpful that I want to point everybody to. This is an IRS FAQ. The IRS publishes their positions on certain things by putting out what we call frequently asked questions. The IRS states the frequently asked question and then answers it. And with that publication, they have given the taxpayer an understanding of what the law is all about. So the IRS FAQ, which you can find under IRS FAQ clawback, the FAQ considered only the tax treatment of the clawback of Ponzi scheme profits, upon which taxes have been paid. They do not consider in this FAQ the treatment of the clawback of an investor's principal. The profits returned in a clawback are deductible as ordinary losses, and they are deductible because they were incurred in a transaction that was originally entered into for profits. But they're not deductible as theft losses. They're deductible as losses incurred in trying to make a profit. The FAQ goes on to say, it's clear that clawback repayments of amounts previously reported as income from a Ponzi scheme are not additional theft loss deductions. Again, it's not under the theft loss deduction section. It is under the mitigation section, where the rights are established to reopen the statute and go back and have your refunds being a result of income that you had reported as taxable income in the past. Now we're going to switch over and we're going to study not the clawback of profits, which is entitled to the mitigation section. We're going to study the clawback of invested capital, This is where a Ponzi scheme person who has made profits pays back their profits, and also because they withdrew capital from the Ponzi scheme very close in time to the collapse of the Ponzi scheme, the trustee in bankruptcy is also able to force those people to pay back some of the principal that they originally invested in their Ponzi scheme. The FAQ does not deal directly with a clawback payment of original principal that was paid into the Ponzi scheme, then withdrawn from the Ponzi scheme, and now has to be repaid in the clawback. Though the mitigation section is not allowed, and the main reason it's not allowed is because there is no tax to be refunded from a loss of principal. The only taxes that can be refunded are the taxes on the actual profits that were made. However, when you repay principal, you're still entitled to a deduction. You have been forced by a trustee to repay principal because, for any number of reasons, you have appeared to have taken an undue advantage of your knowledge of what was going on. Now, the repayment of principal also will happen simultaneously. You'll have settlements at the same time on repayments of profits and principal. Most often, there will be only a repayment of profits. It's very rare to have only a repayment of principal. I've never seen it, but I'm sure it could happen. When we have a repayment of principal, we do not have a frequently asked questions that resolved this issue. The IRS has never published anything that really clearly stated the reason that they still allow the deduction of the clawback of principal. But when you have a settlement agreement that's being reached, you want to make sure to clarify each item and to make sure that you've identified the profits as opposed to the clawback of principal. The clawback of principal only will lead to a deduction in the year you've repaid that principal to the trustee. The clawback of principal has a lot less value, I believe, under the new Trump tax laws, because the clawback of principal is going to allow you to have a deduction in the year you've repaid the principal and no longer have the right to go back in time and go back to prior years, take deductions in prior years if those prior years are still open under the statute of limitations, and have refunds as a result of the deductions in prior years for the payment of principal. So you have to rely on, from now on, just going forward and not going backward when you have a principal loss, which I think could lead to some inequities going forward. Now, the IRS FAQ, it ruled that the clawback of income was entitled to be treated as a loss resulting from the transaction, and the IRS has ruled that the loss of principal is unlike the loss of profits because there is no repayment of income, and that's the distinguishing feature. One good thing is that whether you have a clawback of profits or a clawback of principal, they are both treated as ordinary losses. This is because they are a result of entering into for-profit endeavors. While they're not labeled as theft losses, The IRS is still, because they are part of investments for profits and losses resulting from that, once you have had the clawback by the trustee, you're entitled to the deduction on your principals lost, and you're entitled to the mitigation section on your profits that are lost. And you're entitled to this deduction 100%. We're going to take a quick review of the mitigation section. It's a section of the Internal Revenue Code that corrects an injustice in the tax law. The injustice occurs if profits being returned by a clawback are deducted in a year when they were of little value because the tax rates were low in the year of payment, and yet the income that is paid back was earned in a year in which the taxes were very high. The tax value of clawed back profits may be calculated as the higher of the tax value of either taking a deduction in the year the clawback is paid, or the value of taking a deduction that assumes that the profits that were repaid as a result of the clawback should never have been taxed in the year that they were taxed in the first place. The clawback of profits is not a theft loss. It's an ordinary loss from a transaction entered into for profit. The losses cannot be carried back, but can be carried forward under the new Trump tax bill. This is similar to other profit motive deductions that are carried forward with no time limits. The value of a clawback of profits is entitled to be calculated under tax rules that maximize the clawback's tax value, whether it was deductible in the year it was paid or excluded as income in the year it was first considered as taxable income. This is to be distinguished from the clawback of principal, which is deductible as an ordinary loss, deductible only in the year it's paid, and with now not a loss carryback, but an indefinite period of years to carry forward. When you are in the mitigation section, you will go back to the years that were previously closed years, and you will be treating them as if they were open years, meaning that if there are excess deductions, and those excess deductions, if they were open years, would have been able to be carried back to previous years, you will be able to follow that same procedure and take advantage of the fact that the mitigation section puts you in the same situation as if you were there from day one and able to take the most advantage of your deductions going backwards and forwards. This part of the Ponzi scheme is not affected by the Trump tax bill because the Trump tax bill is really looking forward. It's not going to be able to go backwards and say, in a previous year where you were allowed to reopen the statute, you can't go back and have the same advantages that you would have had you never had taken that profit into your taxable base to begin with. If there's one thing that I want to make perfectly clear, which I hope I have, there is a distinct difference between a clawback of profits, which can be much more valuable than a clawback of principal. When negotiating with a trustee, if there is any opportunity to make sure that you are labeling your clawbacks as clawbacks of profits as opposed to clawbacks of principal, be sure and do so.